This greatly simplified spreadsheet can be used to demonstrate the effect that tariffs have on the spendable income of an individual. Specifically, the spreadsheet is built on certain assumptions. Among these is that the annual income of the individual is $100,000. The individual is salaried with a FICA tax of 7.65%. FICA is basically Social Security and Medicare contributions. Also, the filing status for federal income tax purposes is one dependent claiming the standard deduction. Accordingly, the individual will be looking at a taxable income of $83,430, and that's because the first $16,550 of their income does not have any tax paid on it. By the way, I'll point out that this spreadsheet ignores the impact of state income taxes. More specifically, the income tax calculations are based on the federal tax schedule. Again, that federal tax schedule dictates that the first $16,550 is not taxed. Above that, the next $11,600 is taxed at 10%. Amounts between $11,601 and $47,150, which is a block of $35,549. That's taxed at 12%. Values between $47,151 and $100,525, which is a block of $53,374, is taxed at 22%. For our individual earning $100,000, the first block would yield a tax of $1,160. Again, that's at 10%. Second block at 12% would yield a tax of $42.66. And the third block at 22%, which is based on the difference between $47,151 and $83,450, that's 22% would yield a tax of $79.86. If you add these three up, total income tax on this $100,000 salaried earner would be $13,412. Based on the $100,000 income, that gives you a blended tax rate of 13.41%. When considering the effect that tariffs have on spendable income, there are two items that need to be taken in consideration. Number one is, how much of the stuff do you buy with your spendable income? And what is the tariff tax rate on the items that you do buy that are subject to tariffs? We're going to start off looking at the spreadsheet assuming that tariff tax rate is 0% and we're not buying anything imported, so there's no tariffs involved. We'll jump over to our analysis of one individual. By the way, we have 10 individuals listed here, but we only need to focus on the one. $100,000 salary is offset by FICA taxes, in this case $76.50, and that's because our FICA tax rate is 7.65%. Then there's the computed income tax, $13,412, and that gives us a net after-tax spendable income of $78,938. Now, because we're not buying any goods that are imported, there's no tariff taxes. Accordingly, our remaining after tariff taxes spendable income is the same as this at $78,938. Let's see what happens now when we buy some imported items that are subject to a tariff tax. For this example, we'll say that we're looking at tariff taxes of 10%, pretty low. And we'll assume that of the 78,938 spendable income, we'll spend 10% of that on imported items. Accordingly, we're going to pay $789 of tariff taxes, which will give us $70,255 of remaining cash to buy the rest of the stuff that we would normally want to buy. I want to point out that although the tariff taxes are fairly low, they do represent a loss in buying power. Let's look at this again, but assuming that the tariffs are at a higher rate, let's say that's 25%, we'll stick with our same 10% percentage on stuff we buy subject to tariffs. We've dropped down to $69,000 of remaining spendable income. And that's because we can only buy stuff that would have cost this plus this, and we lost this much more money because of the tariff taxes. We'll take this another step further. Let's suppose that we're facing a higher tariff rate. In this case, let's say 50%. And let's suppose that we end up spending a larger percentage of our gross income on items that are imported. Let's say it's 20%, which is not unrealistic. In that case, note that tariff taxes have gone up considerably, and our remaining money has gone down correspondingly. We can take this analysis a little bit further, and let's suppose that we're looking at buying imported stuff only from China. And right now, we were looking at a 145% tariff on Chinese goods, and we'll leave our 20% number here at the stuff we actually buy that's imported. We jump back over here, our tariff taxes have gone up significantly. And we only have $40,000 left over to buy stuff that's not imported. And again, that means that 80% of what we want to buy is going to have to be bought for $40,000. Now, the trend here is pretty significant. The higher the tariff tax rate, the greater the tariff taxes. The higher the percentage of items we bought that are imported, the higher the tariff taxes, because we're spending more money on imported goods. Now, we can take this a little bit further, and let's assume that we'd like to know how much foreign stuff could we buy and have all the money spent on imported stuff take up all of our spendable money. So what we'll do is we'll try to figure out what this number should be to give us a zero value here. That is to say, take our income, take out what we pay for tariffs and the taxes, gives us nothing left to spend on anything else. That is to say, what percentage of our income here would we be able to spend at 145% tariffs before we ran out of money? And we could do that using a tool in Microsoft Excel called the what if analysis. And we'll go to something called Goal Seek. And in Goal Seek, we can pick a cell. In other words, I'm going to say, let's pick this number here and say that we want to set it to 0 by changing the value of this number. So basically, let's figure out, or have Excel figure it out, that what number here would make this come out to be 0. We click OK. We can see we got our 0, and we can spend 41% of this number on imported items from China before we'd run out of all our money. Another way to think of this is that if Chinese tariffs are at 145%, we would only be able to buy 41% of the stuff we used to buy before we ran out of money. That's pretty dramatic. That's a very severe negative effect of paying a very high tariff if, in fact, everything we bought to survive had to be imported from China.